Hey everyone, welcome to day 86 of our 365-day life challenge. Today we are diving into the fascinating world of investing, specifically the tug of war between passive and active investing. If you're watching this live or catching the recording, get ready for some insights that could redefine your investment game. With respect to mutual fund portfolios, there exist two primary management approaches: active investment and passive investment. When we refer to portfolio management, we are essentially talking about how the fund manager handles the buying and selling of underlying assets, such as equities, debt instruments, gold, and more. In the context of actively managed funds, the fund manager takes on more hands-on role in decision making. They actively oversee the composition of the mutual fund portfolio. Frequently, they make choices about which stock and which bonds to include or exclude, and they determine the optimal timing for these transactions. On the other hand, in passively managed funds, the fund manager lacks the authority to dictate the movement of the underlying assets. While this fundamental distinction captures the essence of the active and passive investment strategies, let's dig deeper into additional differences to enhance our comprehension. An actively managed portfolio involves hands on decision making by the fund manager. This strategy is evident in various types of funds, such as equity mutual fund, debt mutual fund, hybrid funds, and fund of funds. Consider the scenario of an equity fund within this active management framework. In an equity fund, a dedicated fund manager plays an important role in determining which stock should be included or excluded based on the overall performance of the market. An actively managed portfolio involves hands-on decision making by fund manager. This strategy is evident in various types of funds such as equity mutual fund, debt mutual fund, hybrid funds, and fund of funds. Consider the scenario of an equity fund within this active management framework. In an equity fund, a dedicated fund manager plays an important role in determining which stock should be included or excluded based on the overall performance of the markets, economies, and individual stock performance. The fund manager is also responsible for assessing whether the existing stock concentration remains suitable or it needs some adjustment. In essence, the performance of an equity fund and similarly for other fund categories under active management is significantly influenced by the strategic decisions made by the fund manager. So, all right, let's break down the pros and cons of actively managed funds. No fancy jargons, just the straight facts. First up, the pros. Why some investors prefer the active route? So the first benefit is there is a potential for higher returns here. Actively managed funds aims to beat the market. If the fund manager is good at its job, then it could mean you can have more money in your pocket. Second one is adaptability to market changes. Active managers can respond to market shifts. If something is hot, they can jump on it. Third, expert decision making. You have got a pro at the wheel. Fund manager analyzes stocks, economies, and the whole thing. It's like buying a seasoned chef cooking up a financial recipe for you. Now let's talk about the flip side. Actively managed funds aren't all sunshine and rainbows. Here comes the cons. First one is the higher fees. You pay for that expert touch. Actively managed funds usually come with the higher fees, cutting down onto your returns. Second disadvantage is performance risk. The pursuit of beating the market doesn't always pan out. Sometimes active managers miss the mark and your returns might suffer. Third problem can be manager's dependency. Your money is in someone's hand. If the fund manager takes a wrong turn, your investment might fill the bumps. Now, in the context of Passively managed portfolios, we dive into the concept of passive investing using the exchange traded funds, which is called ETFs. Let's take an example. ETFs, by their nature, passively mirror movement of the index. That is the extent of their activity. Unlike actively managed funds, where fund manager make the decisions, in passive funds like ETFs, the discretion doesn't lie with the fund manager, but it is with the regulatory bodies, which is SEBI, Securities and Exchange Board of India. The ETF simply tracks the index movement as what enters or what exists. The index is determined by the regulatory decisions. Consequently, the fund faithfully mirrors the index performance. Any deviation in return could be attributed to factors like expense ratios, management fees, additional charges, or dividends. Consider SBI ETF Sensex as an example. It holds the same stock as the proportion in the Sensex. The fund manager's role is minimal in a passive portfolio. If the Sensex undergoes a restructuring, the fund manager must adjust the ETF accordingly. It ensures it stays in alignment with the benchmark. In passive portfolio management, the fund manager essentially replicates the benchmark's performance without actively steering investment decisions. Now that we got into the basics of passively managed funds, let's break down the pros and cons of the passively managed funds. The first one is the lower cost. Passive funds generally have lower fees and expenses as compared to actively managed fund, saving investors money. Second one, consistent approach. These funds follow a predetermined index. This provides a consistent investment approach without the need for frequent adjustments in the portfolio. Third one is the transparency. Investors know exactly what they are investing in as the holding just mimics the specific index, fostering transparency. Fourth point is market exposure. Passively managed funds offer broad exposure to the market, allowing investors to participate in overall market movement. Now let's turn our attention to the potential downsides. First one is the limited flexibility. Passive funds are tied to the index they track. It limits the fund manager's ability to make strategic adjustment based on market conditions and other factors. Second one, no outperformance attempts. Unlike active funds, passively managed funds don't aim to outperform the market. Investors may miss out on potential high performing opportunities in the market. Third disadvantage is impact of index changes. Changes in the index, whether due to market shifts or restructuring, can directly affect the fund. The fund manager has to adjust accordingly, which can lead to increased turnover. Fourth disadvantage is market downturn exposure. In a market downturn, passive funds don't have the flexibility to move away from the declining assets, potentially resulting in the larger losses for the investors. Now that we have explored the worlds of active and passive investing, you might be wondering, can we have the best of both? Well, let's find out. Combining the strength of active and passive investing is like crafting a well balanced financial recipe. Here is how you can do it. First one, you can have core and satellite approach. Think of your portfolio as a solar system. The core, that is your passive investment, stable and consistent, and the satellite are those your active investment which seeks out the opportunities beyond the core. Second strategy you can have is strategic asset allocation. It's like building a diversified menu. Allocate a portion of your portfolio to passive funds for stability and the rest of active funds for potential growth. Balance is the key. Three, risk management. Picture your investment as safety net. Passive funds provide a stable foundation while active funds acts as a safety rope, adjusting to market dynamics. Fourth is investors' goal. Align your choices with your goals. For long term wealth creation, the tortoise, which is passive, might be your steady companion. But for short term gains, the hare, active, could be your sprinting partner. So, how many of you are already blending active and passive strategies in your portfolio? Drop yes if you are mixing it. So, here is a code to ponder: passive or active, the key is staying in the game. Consistency beats the occasional brilliance. So, these are the wise words for every investor. So, there you have the pros and cons of passively managed funds in plain language. Lower cost, consistency, and transparency are the perks, while limited flexibility and vulnerability to the market changes are the trade offs. With any investment, it's crucial to weigh these factors against your financial goals. If you found this breakdown helpful, give it a thumbs up, share it with your fellow investors, and stay tuned for more insights. Until next time, happy investing. See you tomorrow. Check our comment box. The link for the upcoming session is given there. Bye. See you tomorrow.